Exiting the Canadian tax system by moving to Latin America can save you thousands. But it's not just about packing your bags. You need to sever ties and prove your non-residency to avoid audits. In this video, we're breaking down exactly how to exit the Canadian tax system by moving to Latin America, step by step, with all the practical info you need to make it happen. Canada taxes residents on worldwide income, with combined federal and provincial rates hitting 54% for high earners in Ontario. Moving to Latin America with a territorial tax system like Panama, Costa Rica, or Paraguay can exempt foreign income, slashing your tax burden. But the CRA is sticky, often auditing immigrants to ensure ties are cut. You'll face a departure tax potentially on certain assets, and maintaining Canadian ties risks double taxation. Let's walk through the steps to become a non-resident, minimizing taxes, and settle in Latin America, using Panama as a primary example for its 0% foreign income tax. Step 1, choose a tax-friendly Latin American country. As we've mentioned, Panama, Costa Rica, and Paraguay are often common examples, but you'd be surprised how many tax-friendly countries there are in Latin America. You don't need to go to Dubai. You can just go to Latin America, zero tax on foreign income. It's actually a lot better set up in a lot of ways. So you have Dominican Republic as well, potentially. You have Guatemala, Honduras, El Salvador, potentially Ecuador, Uruguay. Chile has an exemption for a number of years. So there's a lot of tax-friendly options in Latin America where you can go and potentially pay zero tax. So going from 54% tax in Ontario to 0% tax, that's a dream come true. So what you need to do is establish a domicile in this Latin American country by renting or buying a home, say a condo in Panama City, and update your address with banks, the CRA, and institutions like Canada Post. Get a local driver's license and ID, like a Panama cedula, to show intent. Basically, you need residency in the country, temporary or permanent residency. And then you can potentially get to a tax-free status as an expat. Step 2, sever ties with Canada. To exit Canada's tax system, you must become a non-resident by severing significant residential ties, per CRA's guidelines. There are primary ties and there are secondary ties. Sell or rent out your Canadian home. Keeping it vacant risks being deemed a resident, because the intent is maybe you could come back to your empty home. So you can keep your home, you don't have to sell it, but you need to rent it out. We highly recommend a long-term, 12-month lease, rent it out. So just don't leave it empty, don't leave it vacant. Also, move your spouse and dependents to Latin America, as family ties are a primary factor. Cancel your provincial health coverage, cancel your local driver's license and voter registration. This might be the Ontario OHIP or BC's MSP, because continued enrollment is viewed as a tie. Close your Canadian bank accounts or update them to your foreign address, and end memberships like gym affiliations. Avoid spending more than 183 days in Canada annually, as this triggers deemed residency, taxing worldwide income. For example, a retiree in Costa Rica spending 200 days in Ontario risks a $20,000 tax bill on a $100,000 pension. Step 3, handle departure tax and file final returns. When you leave Canada, the CRA deems you to have sold certain assets at fair market value, triggering a departure tax on capital gains. This applies to stocks, non-registered investments, and non-Canadian real estate, but exempts Canadian real estate, RSPs, TFSAs, and pensions. For example, a $500K stock portfolio with $200,000 in gains could incur a $50,000 tax at a 25% marginal rate. File Form T1243 or T1161 if your assets exceed $25,000. to report gains, due by April 30th of the following year. You can defer this tax with Form T1244 and provide security. File for a part year T1 return for the year you leave. Reporting worldwide income until your departure date, using your last province's tax package. Quick tip, hire a cross-border CPA to calculate and defer departure tax, minimizing your liability. Step 4, manage Canadian-sourced income. As a non-resident, you're taxed only on Canadian-sourced income, like pensions or rentals, at a 25% withholding rate, reducible to 15% via various tax treaties. For example, a $2,000 monthly Canadian pension faces $300 to $500 in withholding tax. File a Section 216 election to tax rental income at net rates, potentially recovering withheld taxes, per T4144 guide. Notify payers, like banks or employers, of your non-resident status to adjust withholding. RRSP withdrawals are taxed at 25% for non-residents, but tax treaties with countries like Panama may allow credits. TFSAs lose contribution room, and earnings may be taxed abroad. Quick tip, file Form NR73 with the CRA to confirm non-resident status and avoid over withholding. And by the way, if you want a tax advisor to handle all of this for you, MyLatinLife, we're an immigration and tax consultancy. We can help you get residency in any country in Latin America. We can help you leave the Canadian tax system. There's a link in the description where you can book a call with us, get all your burning questions answered, and make this happen. Moving on to step 5, establish tax residency in Latin America. To avoid double taxation, to leave the Canadian tax system, become a tax resident in your new country. This can also leverage Canada's 90-plus tax treaties around the world. In Panama, spend 183 days annually for tax residency, exempting foreign income. Costa Rica has a similar 183 days test for fiscal residency. Paraguay's is lower, needing 120 days of time on the ground for fiscal residency. There may be solutions to that. The more that you invest in the country, the more easy it is to claim a tax residency. Uruguay has something similar to this, where you can do less days in the country if you invest more in the country in Uruguay to get fiscal residency. Open a local bank account and get a residency card to prove ties. Get a local driver's license. Me, I have like 5 different driver's licenses. So from Panama, Costa Rica, whatever country you become a resident of, that's when you're going to get a driver's license from. And by the way, we can get you other driver's licenses as well. Maintain minimal Canadian ties. Secondary ties, like a passport, don't count if significant ties are cut. So it's sort of a mosaic picture where there are primary ties, there are secondary ties. If you get rid of most of those primary ties, like taking kids out of school and getting rid of your health insurance, then some secondary ties, like having 1 or 2 bank accounts in Canada, it's not a big deal. Some pitfalls to avoid. First, incomplete tie breaking. Keeping a Canadian home or driver's license risks deemed residency. Second, spending too much time in Canada. Over 183 days triggers worldwide taxation. And I would say for the first couple of years when you leave the system, try to do less than 100 days or less than 120 days in Canada, so it doesn't look like you have intent to return. Third, missing departure tax filings. Failing to file T1161 may incur penalties. Fourth, ignoring local tax rules. Panama's 0% tax on foreign income requires residency proof. It requires earning that money outside of Panama so that it's foreign sourced. So that might require having a US LLC, creating a bit of a structure, right? So there's more to it. Fifth pitfall would be neglecting CRA notification. There is this form NR73. So if you want, there's kind of a strategy here, but not filing form NR73 leaves your status unclear, risking audits. Pro tip, document all ties like foreign leases, IDs, and travel logs to prove non-residency. Some practical tips, hire a cross-border CPA to handle departure tax and treaty claims. If you need one, we have one. Again, link in the description to book a call. Get that residency in hands as quickly as possible from Latin America, because you can't leave your Canadian tax system. You can't leave paying taxes in Canada until you have residency in a foreign country. So you need legal residency somewhere before you can even actually leave. So get the residency in place before you need it. It's better to have it and not need it than need it, not have it. Okay, so that's the complete guide to exiting the Canadian tax system by moving to Latin America. From severing ties to dodging departure tax legally, these steps save you thousands while embracing a vibrant life. Our top takeaway: look at Form NR73, cut all Canadian ties, and document your new domicile to stay audit-proof. If you found this video helpful, smash that like button, subscribe, drop a comment with any questions that you have about Canadian taxes, any stories, and we'll see you in the next video.